What are the risks of trading wheat futures? In today's fast-paced financial world, the question on many investors' minds is, what are the risks of trading wheat futures? With recent market fluctuations and global events, understanding these risks is more important than ever. Just yesterday, wheat prices saw significant swings due to weather concerns in major producing countries. If you are considering entering this market, you will want to know what to watch out for. Trading wheat futures involves several risks that investors should carefully consider before entering the market. First, price volatility is a major risk. Wheat prices can fluctuate widely due to factors such as weather conditions, geopolitical events, changes in supply and demand, and currency fluctuations. For example, a strong United States dollar can reduce the competitiveness of United States wheat exports, putting downward pressure on prices. Similarly, weather patterns affecting major producers like Ukraine or Brazil can impact production forecasts and cause price swings. Second, market risk is significant because futures prices can move against a trader's position quickly. This can lead to substantial financial losses, especially since futures trading often involves leverage, magnifying both gains and losses. The risk of loss in commodity futures trading is generally high and may not be suitable for all investors. Third, liquidity risk exists if there are insufficient buyers or sellers at a given time. This can make it difficult to enter or exit positions at desired prices. This situation can increase transaction costs or force traders to accept unfavorable prices. Fourth, basis risk arises from the difference between the futures price and the actual cash price of wheat at contract expiration. This can affect hedgers who use futures to manage price risk but may not perfectly offset losses or gains in the physical market. Fifth, regulatory and geopolitical risks can affect wheat futures. Trade policies, tariffs, export restrictions, or geopolitical conflicts involving major wheat exporters like Russia, Ukraine, or the United States can disrupt markets and create uncertainty. Lastly, margin calls and financial risk are important considerations. Because futures requiring posting margin, adverse price movements can trigger margin calls, requiring additional funds to maintain positions. Failure to meet margin calls can result in forced liquidation and realized losses. The risks of trading wheat futures include price volatility, market risk amplified by leverage, liquidity challenges, basis risk, geopolitical and regulatory uncertainties, and margin-related financial risks. These factors make wheat futures trading complex and potentially risky for investors without sufficient knowledge or risk tolerance.